Welcome to the tutorial of the CoValue app, Value Impact. In this module, we will assist you in evaluating various decisions that are taken to create value. Which value drivers create most value? What the sensitivity of the CAGR of sales and target operating profit margin value drivers on shareholder value. The Value Impact module uses the discounted cash flow model. The module can be used for undertaking value impact of any company except banking, finance, and insurance companies. We suggest you watch our Know Your Worth tutorial before proceeding with this tutorial, as this video draws information from the earlier module. The user has options to either create a valuation plan from DataBank, edit an existing value impact plan, import valuation from the Know Your Worth module, or create a valuation plan without DataBank. For convenience, we create a valuation plan for Netflix with World DataBank from the Value Impact module. We can change country DataBank to the respective country or exchange where the stock is listed and proceed after naming the plan 20th December 2022. This example is just an illustration for the tutorial to understand the working of the app. In the basic information screen, you can see information like company name, prior period, currency, number scale, and risk fee rate are pre-filled in the app. The prior period is usually the prior period ended for which the information is available. The currency is US dollar. Figures are in millions or billions and are set by default. The forecast period can range between 1 to 99 years, depending on longevity of the business, brand value, its economic moat, the industry scenario, etc. For Netflix, we take a 10-year forecast period, during which we expect the company to earn above its cost of capital. You can click the history icon for historical data and analytics for the company. The assumptions entered in this and following screens are for the cash flow drivers during the forecast period. There is a separate screen for terminal period assumptions. For risk-free rate, the latest 10-year Treasury bond yield is pre-filled at 3.67%, but is open for edit. The user may click the history icon to check the date and yield. You will need to enter the expected inflation rate expected during the forecast period. Ensure that the risk-free rate is greater than the expected inflation rate, as generally the Treasury bond yield incorporates the expected inflation rate. The user may click the history icon to check the history and CAGR of inflation. Here we take 3.25% as the expected inflation rate during the forecast period. Ensure that the changes, if any, made in the inflation rate needs to be reflected in the computation of cost of debt and cost of equity. You will now need to save and continue to move on to the next screen. Advancing to the cash flow drivers screen. Sales and growth. Sales for the prior period is pre-filled in the app. Sales figures here exclude the non-operating income. Users can refer the history icon to view sales growth throughout previous years. For Netflix, we assume a 12% CAGR of sales for next 10 years. The next is operating profit. Prior period operating profit is pre-filled. Users can refer the history icon to view operating profit and margins throughout previous years. We assume that Netflix target operating profit margin is expected to be around 20% during the next 10 years and sustain. Incremental fixed assets investment is the expected capital expenditure over depreciation. Users can also refer to history to check incremental fixed asset investment rates of the company throughout the previous years. The history shows that the fixed asset to sales ratio until the prior period is over 100%. We assume the incremental fixed assets investment rate to be 75% during the forecast and terminal period. Incremental net working capital is the investment required in the working capital to grow the sales. Net working capital is operating current assets less operating current liabilities less non-current operating liabilities. It is given as a percentage of incremental sales. Users can refer to history icon on top right corner of the screen. Netflix incremental net working capital investment rate is taken at -20% during forecast and terminal period. The marginal income tax rate is ideally entered for the forecast period, assuming the tax rate is expected to stabilize to this rate on an average in the long term. For Netflix, we have taken this as 21%. The balance sheet non-operating screen essentially consists of non-operating items that do not contribute in generating operating cash flows. The non-operating assets and liabilities will need to be added or subtracted from the present value of cash flows from operating assets to arrive at the shareholder value or intrinsic value. This section also displays the debt, non-operating liabilities, and the outstanding shares as on previous closing day. All items are pre-filled. However, they are available for edit, just in case the user wishes to edit. Users need to review the investments in affiliates, real estate, non-operating and minority interest to reflect their fair value, as these could be taken at book value. Now we advance to the capital structure screens, which gives the breakup of debt and equity. Debt is at book value. Equity is taken at the market value based on the last trading closing price. The app uses market value of equity to compute the debt-equity ratio. To insert the same ratio for the debt-equity ratio, users can just double-tap the mentioned area to copy it, or you can change to the ratio you expect to maintain during the forecast period. The debt-equity ratio is changed for Netflix and is assumed as debt at 10% and equity at 90%. Cost of debt and equity. Now we look at cost of debt and equity. The cost of debt is taken by looking at the risk-free rate and the default spread of the company. The cost of debt should be based on the currency in which the valuation is done and is for the forecast period. The cost of debt for Netflix is assumed at 5.5% during the forecast period. Enter the cost of equity during the forecast period. Users need to refer the history icon to view computation under capital asset pricing model in the user input column. Users can also deploy other models or just use expected market return, which is an implicit rate of return the investors expect in the stock market. The cost of equity for Netflix is taken at 11.32%, as per capital asset pricing model as on 20th December 2022 during the forecast period. Advancing to the terminal period screen. The cash flows of the company continue post the forecast period and thus have value. Terminal period assumptions help to forecast the cash flows into perpetuity. In this screen, you need to enter your cost of capital and terminal growth assumptions. You will need to enter the expected inflation rate expected during the terminal period. The user may click the history icon to check the history and CAGR of inflation for the currency for up to 30 years. Here we take 2% as the expected inflation rate during the terminal period. Ensure that the risk-free rate is greater than the expected inflation rate, as generally, the Treasury yields should incorporate the expected inflation rate. Here, we take 2.25% as the risk-free rate during the terminal period. This is assumed as inflation of 2% plus real interest rate of 0.25%. The marginal income tax rate is ideally entered for the terminal period, assuming the tax rate is expected to stabilize to this rate on an average in the long term. For Netflix, we have taken this as 21%. Now we enter the debt-equity ratio to be assumed during the terminal period in the terminal period screen. The debt-equity ratio for Netflix is assumed as debt at 10% and equity at 90%. Now we look at cost of debt and equity. The cost of debt is taken by looking at the risk-free rate assumed in the terminal period and the default spread of the company. The cost of debt should be based on the currency in which the valuation is done and is for the terminal period. This should be greater than the risk-free rate. The cost of debt for Netflix during the terminal period is assumed at 4%. The cost of equity for Netflix is computed at 10.1%, as computed by the app. However, we have reduced the beta from 1.18 to 1, as we expect beta to be around expected market return. Thus, the revised computation comes to 8.9%. Before you enter the terminal growth assumptions, you will need to be clear how you want the cash flows to grow. If you expect the cash flows to grow at terminal growth rate, then enter the inflationary growth and real growth assumptions. Or, if you want the cash flows to grow at expected inflation rate, then enter only the inflationary growth, then enter real growth assumptions as 0. Or, if you want the cash flows to remain constant, then enter 0 for both inflationary growth and real growth. The inflationary growth should be in line with the inflation rate assumed during the terminal period. This essentially is the pricing power of the company and its ability to keep up with inflation. The user may click the history icon to check the history and CAGR of inflation for the currency for up to 30 years, and also refer to the inflation entered during the terminal period. We assume Netflix the inflationary growth at 2%, which is as per the expectations entered during the terminal period. The real growth expected into perpetuity should take into account the country GDP growth rate, industry growth rate, and the world GDP growth rate. The user may click the history icon to check the history and check the CAGR of GDP growth for the country and the world for up to 60 years. Here, we assume Netflix real growth to be in line with the world GDP, and hence the real growth is taken at 2%. You will need to ensure that the terminal growth is not greater than the weighted average cost of capital of the company. Advancing to the relative impact value section, we ascertain the effect of the various value drivers on shareholder value. In this screen, we compute shareholder value for an increase of 1%, as we see CAGR of sales, which is 12%, becomes 12.12%, not 13%. While keeping other variables constant, we can see the relative impact of this change on all value drivers on the shareholder value. We can now view the relative value impact changes and report on the screen for each of the value drivers. As we can see, operating profit margin for Netflix has the maximum value impact and sensitivity. You can email the reports from here or share the plan data via an email or messages with other users of the app. We now go back to reports. Advancing to shareholder matrix section of value impact. The shareholder value matrix allows you to view the reaction of two value drivers, that is sales growth rate and target operating profit margin, on shareholder value and shareholder value per share. You must enter 4 different percentage rates for sales growth and target operating profit margin and see the result in form of a shareholder value matrix for shareholder value and shareholder value per share. We enter CAGR of sales ranging from 10% to 16% and target operating profit margin from 20% to 30% under 4 scenarios and save and continue. You can now view the shareholder value matrix report on the screen. The report shows the shareholder value per share and shareholder value for a combination of the 2 value drivers. The report also displays the current market price and market capitalization. You can email the reports from here or share the plan data via an email or messages with selected users of the app. Thank you.